Welcome to OpalesqueTV. Today I'm in Zug in Switzerland together with Daniele Scilingo. Daniele is the partner and portfolio manager at Nanos Investment. At Nanos, Daniele runs a strategy with the motto compounding wealth while sleeping soundly. Now, if I look at his chart, I think investors in his fund really have achieved that. So let's look into this more in detail. But first, Daniele, give us some background about yourself and your investment history.
As you mentioned, Nanos Investment has the motto of compounding wealth while sleeping soundly. And the gestation period of this motto is over 25 years. I spent the first 10 years as a sell-side analyst at Vontobel, analyzing companies, mostly Swiss companies, with fundamental analysis, trying to figure out where are the healthy business models that have a moat that can survive also difficult times, like we had a lot in Switzerland. And then as a money manager, I put this in practice, putting money into exactly these companies, trying to perform as well as possible for the client's money. During these 14 years at Pictet, the calibration of what I did and also the stripping down my process to the very things that are important to perform was one of the main things that I learned during these 25 years. And being on my own, I can now put into practice everything that I learned without any compromising, without any institutional handcuffs.
So Daniele, tell us more about Nanos Investment, your new company now.
So Nanos Investment is a unit of crossbow partners, and it has been set up to develop sophisticated long-only, I call it, to cater to the needs of private wealth, but also institutional asset managers. What is quite unique is that we try to find the wrapping around that is ideal for our investor base. As the first product, we launched an equity note that is called BB Nano Swiss Compounders, that is focused on the universe of Swiss equities. On the one side, because I'm home biased and I'm passionate about the many excellent business models in Switzerland, but then also because in Switzerland, with the unique setup that we have as a small country, very strong currency, and very small captive market, the companies that flourish here, they are very competitive, they are in niches, and they are absolute world leaders. So we have plenty of compounders to be found, to be analyzed, and to be invested in. The product is dominated by the philosophy and by the investment process that I developed over the years. So one of the key features is that I run a very concentrated portfolio. At the moment we have 15 stocks that are selected with a meticulous analysis of their compounding potential. Over the years, I developed a score or a rating that I call the NICE score that tells me in one number how much compounding potential there is in a business model. Unfortunately, in today's time, a lot of people spend many hours trying to figure out what the exact value is of a business model in 5 years. And as you can imagine, most probably the number is wrong. So I rather focus my time to establish what durability a business model has, how good it is, how well it can grow, and how much value it can generate for the investor. And that's 80% of my time is spent with that. And with the rating system that I've developed, it helps me to be honest, to be transparent, to score certain elements of a business model that are qualitative, like management quality. And so the aggregation of all these elements, management quality, return on capital employed, growth opportunities, but also risks, give me one score that allows me to assess the compounding potential of a company. So like the Parker scoring for Bordeaux, when I look at the number, I can see if this is a good vintage or if this is a vintage that I should rather avoid in my investment portfolio.
So Daniele, if I look at your chart, I mean, it's clearly that you have outperformed your local Swiss benchmark. It's absolutely impressive. I think the question that now comes up is, how diversified are you? And number two, what do you do any risk management, hedging after having achieved such a run-up?
Yes, Matthias. So in terms of diversification, I love to be concentrated in 10 to 15 stocks. But there is tons of empirical evidence that shows that after your 11th, 12th and 13th position, the additional diversification effect of one more stock is pretty limited. With a concentrated portfolio, what I focus a lot on is to make sure that the investment drivers that are in my portfolios, they are diversified, so they are not all correlating with one single bet, and that's the main diversification that I have. And you spoke about hedging. What I do as a fundamental stock picker is I like to hedge part of the bad seasonality. Everyone can run a seasonality chart and see that from June to September there are some instances in the statistics that show there is not the best period to be invested. Now, my money is in the product as well, so do I want to stay completely exposed to a market that has suffered many corrections and even crashes during that period? Most probably not. And the second element is if we have binary events or political events that I have no clue where they go out, I just hedge part of the exposure with put options on indices to make sure that if they go completely away from expectations and the market corrects, that my capital, our capital of the investors is protected.
Daniele, I think most investors and also most managers are of course very interested in compounding their net asset value and compounding their wealth. Tell us in more detail, how do you compound your net asset value? What are your methods here?
In my long experience as an investor, I realized that the best compounding effect on your wealth you have by investing in compounders that are trading below what I believe is intrinsic value. When I say compounders, I mean companies that have very high return on capital employed, they have good generation of cash flow, and they have the ability through a good management to allocate the capital that they generate in a profitable way, or they pay it back to the investor. If you find these gems or jewels and you can buy them at fair prices or at below intrinsic value, and you have a very long-term horizon for investment and patience and discipline, these compounders, they can yield exponential results over the longer term. And of course, to be able to compound your wealth at interesting rates, the fee structure plays a dominant role in it. So when we offer the services to investors, we want to make sure that, as we call them, the co-investors and partners, they get a transparent and fair deal. For me, fair deal means that we have zero management fee. The emittent of the certificate charges a minimum administration fee, but we as Nanos Investment, we get zero fixed management fee. We have a hurdle rate of 5% per annum that you as an investor, you get for free. If we are not able to compound our net asset value above 5% per annum, that is more or less the return of an equity market, we don't deserve to exist and we don't deserve to gain any fees. Above that, we share the performance that is above 5% with 25% for us and 75% for the investor. So as a result of it, we make sure that the majority of the performance we generate stays with the investor at all time. And this was one of the goals that I had by setting up a brand and a unit on my own, that I want to service the client so that the client can compound rather than the business that I'm running compounds and the client stays with minimal returns.
Daniele, you spoke about establishing fair value for a company and getting in and getting out at certain points. Tell us more details about this investment process of yours.
So we spoke about the first step, that is to establish the quality and the compounding potential of a company. But then of course I want to buy it to have potential upside on its intrinsic value. So what I do is I use three methodologies to establish the value. One is the DCF that everyone uses. I borrow or steal or whatever, take broker models and tweak them around so that the terminal growth rate and the discount rate matches what I think the business model should have. The second is the Benjamin Graham PE. That is a very simplistic model of multiplying your EPS by 8.5 plus 2 times growth. It's very simple, but empirically it has shown that there is some merit to it. And the third one is developed by Bruce Greenwald, the guru of value investing that sits in Colombia. It's called the earnings power valuation that combines return on capital employed, the required rate of return, plus integrates a growth element that from my point of view is extremely important to take care and to cater to the characteristics of the compounders. So when I get this intrinsic value and I forecast it in 5 years' time, I know that all three of these price targets will be wrong. But it gives me a certain margin of safety that if I have 10, 15% per annum over 5 years, I know that even being wrong on certain parameters, I have enough margin of safety that most probably I will not lose money and I will make some money for me and for my investors. And this is the approach that I learned over time. So you can spend years fiddling around the model. The result is more or less the same with some nuances and degrees of difference. And I rather spend my time establishing and finding good compounders rather than the exact wrong price target in 5 years.
Daniele, with your compounding strategy, which is a wealth generating strategy, you're focusing on the Swiss market. For many investors, for many international investors, the Swiss market is more seen as a defensive market. Why do you see the Swiss market differently?
That's right, the Swiss market is regarded as a defensive market, mostly because the three big ones, Roche, Nestlé and Novartis, make up 50% of the SPI, the Swiss Performance Index. But if you look below the surface, what is happening there, there are tons of smaller cap companies that are in niche markets, that are dominating their niche and that are globally active in cyclical businesses as well, that can develop and grow geographically with huge innovation. I think the Swiss market for international investors has been disregarded as Europe or as defensive, as you say. But if you look at the composition, the innovation power, the competitiveness that they in the rankings, they are almost always number one. It gives us the opportunity to dig deeper into it. And the equity notes that I run can fish for ideas in all cap areas. So if you invest in just a small cap fund, you forgo the opportunity to invest in smaller large caps that are in the large cap index. If you use an SPI tracker, you will have 50% of your wealth invested in the big three. And I'm telling you, you can buy this big three on your own. You don't need to pay me a management fee to own this three. So by investing a slice in the product that we run, you will get exposure to the best run mid and small caps, but also smaller large cap companies with a wealth track record that is impressive. Over the last 25 years, the mid and small cap index has performed 10% per annum in Swiss francs. And I challenge you to find an asset class that has delivered this performance consistently over time for investors.
Daniele, you mentioned that you're completely transparent regarding your position. So I wonder now, how do you keep your edge?
We spoke a lot about identifying compounders, and as I explained, the names don't change a lot. With the transparency that you allude to, this is a monthly snapshot of the names that are in the portfolio and the sizes. But the sizes, they change quite often also during the month, depending on the events, on the volatility of the stock. But also I like to put derivative strategies around the stock if I see that an event is happening. Is it an earnings report? Is it a product launch of a biotech or a pharmaceutical company? Or just the punctual hedging of certain events that can be not replicated, that certainly needs to have someone that is on the ball for the whole time and that knows the Swiss companies extremely well inside out. A company releases figures, the figures are good, the stock goes down 10%. If you are detached from the market and from the company, you wouldn't know how to react. Very often I can double check very quickly with my contacts if something is wrong. If not, I can double up the position very quickly. That happens pretty often in the last 18 months when I was running this strategy and added a considerable amount of value on the top of the compounding effect that you have by owning good companies.